I'm good. I'm good. So, for those who don't know me, I am Mary Beth. I am a real estate professional and I'm on the Michael Blanc team. I'm a part of his wonderful Dealmaker Mastermind community. And today we have Jason joining us. We're going to do a deal analysis. He's got a lot of great information. Can't wait to dive in. So, Jason, can you give a brief introduction about yourself?
Sure. Thanks, Mary Beth, and thanks again for having me today. My name is Jason. I've been in the multifamily space going on about 20 years now. I was a broker with Marcus and Millichap back from '06 to 2010. Then various acquisition roles from 2011 through the end of 2021. A majority of that time was spent as director of acquisitions at a private equity firm multifamily shop. Here I'm located in the Bay Area in San Francisco. Left that at the end of 2021 to really get out and start my own shop doing JV and syndication opportunities, which landed me with the Michael Blanc program. And here we are today.
Awesome. Great. So today I know we're going to talk about some deals and something that's really great. You're really into like the anatomy of a deal and you've got some helpful points that you want to share. So let's dive right in.
Great. So I'm going to pull up my screen here real quick. Let me share the screen. And as you said, Mary Beth, I really I like data. And so, the way that I'm looking at the presentation today is for folks that might just be getting in. So talking about the building blocks of getting to the point to where you find a deal. And then from finding the deal, I do 3-level cuts typically. A level 1 cut, back of the napkin, real quick, literally takes me 20, 30 seconds, maybe a minute. Level 2 cut, I actually dive in a little bit to the scenarios tab, do a couple of inputs. Then I kind of compare some numbers and see, okay, does it take a level 3 cut, which is a deeper dive? And given the amount of time we've got today, I'm going to go through some stuff pretty quick. There's going to be a lot of information here, but I'll try to get through it and be as detailed as possible. And certainly, if anyone's on the call now, any questions, we can table those for the end. And then after the fact, if anybody wants to reach out through the platform, certainly feel free to do so. So let
Awesome.
me pull up. All right. So just to set the stage for the agenda here today, as I mentioned, I look at this as building blocks, and what I wanted to do was build it from the ground up. So number one, how to identify a market. Number two, once you've identified the market, identify the property type and tier location within that market. Then three, how to identify the neighborhood within the tier location. Four, how to identify the local players to help you find deals in that neighborhood. And lastly, once we've done the above and identified a deal, I'm going to show you my model, which I've made some tweaks to, and how I do my analysis from the initial look to a deeper dive on a specific deal that I missed out on last year, which will involve my level 1 cut, level 2 cut, and the level 3 cut, which is a full underwriting. And we don't have the time for that today, but I'll show you the model, walk you through some specifics, some things to be, aware of and focused on. So without further ado, identifying a market, some key market attributes that you want to look for. Population growth, median household income, median house and condo values, crime in that local market, and job growth. And population growth for MSAs between 250K and 2 million, you want to target about a 15% growth. And this is between 2012 and 2021. For larger MSAs, target above 2 million, 7+% growth from 2012 to 2021. Median household income, target growth greater than 35% between 2000 and 2021. Median house and condo value, target growth greater than 58% between 2000 and 2021. Change in crime levels for the current year, target MSAs with crime less than a 450 index, and that's a national average, are great spots to be really looking and focused on. And then 12-month job growth percentage. This information can be difficult to find depending upon the size of your market, but you want job growth greater than 2% for MSAs less than 1 million, and this is over a 12-month look back, and greater than 1.5% for MSAs larger than 1 million. And these are numbers that Michael has talked about, location and number and analysis, and others within the space. So this is pretty consistent stuff. It changes on an annual basis, but this is pretty current information, and helpful.
Very
Tools to
helpful.
help.
Yeah.
What's that?
I said very helpful.
Yeah, and some tools to help find this information. The majority of what I just went through, Google search for the population growth, punch in the city, go 2012 to 2021, get your delta change. Citydata.com is going to have items 2, 3, and 4. And then department of numbers, depending upon the deal size or location, I should say, will give you number 5. You can also use US Censa, Neighborhood Scout. Some other helpful tools are brokers, reports. And Harvard University has their Joint Centers for Housing Studies and put out some really great publications. Now, the next step would be once you've identified, excuse me, a market, you want to identify a property type and a tier location. So property types, class A, B, and C, right? For the most part, we're looking, I'll speak for myself, value add B, C, and products. Class A stuff, it's newer product, stabilized, not a lot of meat on the bone for any value add plays. Maybe some older value add that's 10 plus years old. Decent stuff, but still price point's pretty high, and it doesn't really make any economic sense. But I'll run through how to identify class A, B, and C quickly. Class A properties are typically newer or recently renovated buildings located in prime and high demand areas, offer modern amenities, high quality finishes, upscale features such as fitness centers, swimming pools, concierge service, and high-end appliances. Class A properties command the highest rental rates in their respective market and attract tenants with high income. These properties are considered to have low operational risk and may be more resilient to economic downturns, but for COVID, depending upon location, of course. Examples include luxury apartment complexes in urban core or affluent suburban neighborhoods. Class B properties are generally older than Class A and may have some deferred maintenance or cosmetic issues. They offer functional, mid-range amenities and features that appeal to a broader tenant demographic. Class B properties are typically located in stable, middle-income neighborhoods with moderate rental rates. While they may require some upgrades or renovations, Class B properties often provide solid cash flow and capital appreciation potential. Good targets for us. These properties represent a balance between affordability and quality, appealing to a diverse tenant base. Examples include well-maintained apartment buildings in established suburban or urban areas. And Class C properties are older buildings with dated or basic amenities and may require significant renovation or repairs. Located in lower income or transitioning neighborhoods where rental rates are more affordable, they tend to attract tenants with lower income and may have higher vacancy rates and turnover. And again, all of this is depending upon the economic climate as well. These properties offer the lowest rental rates among the 3 classes, but may provide higher cash flow potential for investors willing to undertake value-add strategies. Class C properties are considered higher risk due to their age, condition, and location, but they can offer attractive return for investors with a higher risk tolerance. So depending upon your investor profile, Class C properties could be attractive to some. Examples include older apartment complexes in less desirable urban or suburban areas. And then the tier locations, you've got core, secondary, and tertiary. Core markets are typically large, established metros with robust economies, diverse industries, and stable real estate fundamentals. Their markets are considered highly desirable for investment due to their strong population growth, job opportunities, and demand for real estate. They attract significant institutional investment and offer prime assets with lower profile, albeit at higher price points. Secondary markets are markets that are smaller, regional cities or metropolitan areas that serve as economic hubs to their respective larger core market. While not as large or as prominent as core markets, secondary markets still offer attractive investment opportunities and real estate fundamentals. These markets may have slower but steady population growth, moderate job expansion, and a diverse mix of industries. Secondary markets often provide a balance between risk and reward, offering relatively stable investment environments with potential for growth and yield. So think of it as, maybe a 30-minute, 45-minute, and in some locations an hour commute from a major MSA. Secondary markets here in the Bay Area, those are an hour and 15-minute drive. So, it can be as close as 15 minutes outside of core to an hour and 15, maybe even an hour and 30, depending upon the commute and the location and region that you live in. Tertiary markets are smaller cities or towns or rural areas located outside of major metropolitan areas and secondary markets. These markets typically have limited economic diversity, slower population growth, and fewer investment opportunities compared to core and secondary. Tertiary markets may rely on specific industries or sectors for economic activity, such as agriculture, manufacturing, or tourism, which creates a very high risk profile. While they may offer lower priced real estate assets, tertiary markets are often characterized by higher risk due to their dependence on a narrow economic base and potential volatility. Examples of tertiary markets include smaller cities, suburban areas, and rural communities located away from major metropolitan population centers. So now, once you've identified your tier, drilling down further into neighborhood characteristics. Location, location, location. Proximity to employment centers, transportation hubs, major highways and public transit options, access to amenities such as grocery stores, restaurants, retail shops, parks, schools, and healthcare facilities. And now I'll pause for a moment. These neighborhood characteristics fall within any tier, core, secondary, tertiary. If you're buying an asset, you want to have these characteristics, whatever size market that you're going to be in. Economic stability, low unemployment rates and diverse job opportunities in various industries, presence of stable employers, corporate headquarters, and government institutions, economic growth and development trends in the area. Demographics, population growth and demographic trends, including age, income levels, household size, and education, and target market preferences and lifestyle considerations such as family-friendly neighborhoods, urban areas, or retirement communities. Market demand, supply and demand dynamics for rental housing in the area. You want that, of course. Vacancy rates, know your absorption rates, and rental trends for the multifamily properties in that submarket. Know your competition from other rental properties and new developments in the neighborhood. Safety and crime rates. You want low crime rates and a safe environment for your residents. You want access to police and emergency services and community policing initiatives that are active within the community. School district and quality of public schools and educational institutions, school district ratings. Greatschools.org is a great resource for that. Neighborhood aesthetics, overall cleanliness. Have you driven the neighborhood? Do you see oil stains in the streets? Are there cars on blocks? Are there bars on windows? These are all just small things to consider as you're looking and diving deeper into a local neighborhood. That can really mean a lot. Do you see windows replaced in a neighborhood throughout the communities, right? You see a lot of long-term owners with just dilapidated small homes. All those are key indicators as to the health and viability of a local neighborhood. So overall cleanliness, upkeep, attractiveness of the neighborhood, architectural style, landscaping, curb appeal of surrounding properties, infrastructure and utilities. Is there adequate infrastructure, roads, sidewalks, lighting, utilities, availability of services, and then regulatory environment. Excuse me. Zoning laws, land use regulations. Is there a lot of dirt around the property? Can they go vertical with a new building to compete with you in a matter of months? Permitting process for improvements or new development. Property tax rates and assessments. Those can really get you if you're not very clear on how that happens on an annual basis once you acquire an asset. Tax incentives or abatements that are available potentially. Is it landlord friendly? I'm in California. California is not. Many other states across this country are. So understand where you're looking to invest. Community amenities, recreational facilities locally, cultural attractions, entertainment venues, green spaces, walkability, bikeability, public transportation options for residents. Think about a location where you would potentially be a resident living. Is that a place where you want to be? Do these amenities appeal to you? Think about it with your in their shoes, right? And then help you you need local players to help you find a deal. So brokers, commercial real estate directories, LoopNet, CoStar, Crexi often feature directories for search functions to find commercial brokers, including those specializing in multifamily. Real estate associations and organizations. I'm going to go through these fairly quickly, just so I have time to address the underwriting component as well. Industry publications and websites. Online marketplaces, Zillow, apartments.com, realtor.com, Crexi, LoopNet. They are great resources to find brokers that are doing deals. Professional networking platforms, LinkedIn, great source to find guys that are and ladies that are in the space. Local real estate board and associations, brokerage firms and websites. Right there, you're going to the source. Trade shows and conferences. Try to get out on a biannual or annual basis or even quarterly. Great way to meet people in various parts of the business, from folks in title, brokers, folks that are in local real estate agencies, things along those lines. Just a great way to meet people and just build out your sphere and local meetup groups as well. So now that we've completed the steps above and we've been able to identify a deal, it's time to see if it's worth underwriting the deal, right? And this is the biggest thing. Right now, it's a numbers game. So the way that I look and approach underwriting a deal, I've got 3 levels. I call level 1 is a high cut, Level 2 is just a little bit of a deeper scratching the surface dive, if you will. And level 3 is a full underwriting. I'm going to show you a deal that I looked at last year and pursued, got into a best and final, and lost out on, unfortunately. And I'm going to give you reasons why I like the deal and pursued it based on the criteria that we just went through above. I will then show you the offering memorandum, and then we'll quickly dive into, I'll show you actually the high level cut, the scratching the surface cut, and then we'll jump into the actual model that's already, again, been populated from the pursuit last year. So this deal was a small deal, excuse me, 30 units in Davis, which is a city that is due east, about 45 minutes outside of the Bay Area here where I live, and just about 30 minutes or so due west of Sacramento. So great location. UC Davis is a phenomenal university, ranked by US News and World Report in the 2024 best colleges, #1 nation for veterinary medicine, #6 in the nation among public universities, #10 in the nation by value. The location of this opportunity was less than a mile walk to UC Davis. So there was a mix of students, predominantly graduate students, and a few market rate folks. Ample public transportation in the area, ample outdoor lifestyle options. Got a great, vibrant downtown, which is walkable. Proximity, as I said, to Sacramento and the Bay Area. Very difficult to develop location, however, and an email just came through today that I saw. 3,000 units were added in the city last year, which is the most in 20 years. However, the occupancy in that submarket is still north of 97% across all properties in that submarket. So it's extremely tight. Growing student population continues to create that supply and demand imbalance. And this was a pride of ownership deal, long-term owners. So if I can, I'm going to show you the OM real quick.
It's awesome. And thank you too. This is so thorough and in-depth and helpful. And I'm taking notes over here. And this is really great, Jason. Thank you.
Of course. Oh, sorry, guys. Let me pull up the, oh, here we go. All right. All right, can you guys?
Yes, I can see that.
Great. Let me move this out of the way. All right. Here's the deal. You can see it extremely clean. Pride of ownership deal. 30 units with the opportunity to take an existing recreational space and create it into a studio, which we had planned to do. 2-story flat roof, garden style, relatively low density. Again, fantastic location. Well-landscaped grounds, very nice park-like setting. Some of the property highlights, predominantly 1 bed, 1 bath, which I'm not a huge fan of. I like a nice split between 1s and 2s or 2s and 3s, whatever it might be. But again, because this was graduate students, proximity to the university, I wasn't very concerned about, turnover, but for, on an annual basis for school. 2 bed, 1 bath as well, for a total of 30 units with the option to create 1 additional studio recreational unit into a studio. The ask at the time was $8,250,000, which seemed extremely rich. A lot of people around the country are going to gag when they look at, price per pound on a price per unit of $275 a door at a 4.25 cap. It's just the economics of the Bay Area and California in general, depending upon location. Highly desirable spot. Economics there have changed as they have around the country with the increasing interest rates over the last year or so. And I'll point to some of the numbers that I was using last year, interest rates, et cetera, as we talk about it. But again, you can see just a very appealing property. Curbside, it's got just a great appeal. Oh, also recent capital improvements, dual pane windows throughout, roof overlay, new boiler, repaved parking lot, and 7 new HVAC of the 30 units. So this is a pretty consistent condition of the existing units. So you really didn't have to do a lot, but you could go through, and what we had proposed was an upgrade package that would include stainless and some new lighting and hardware finishes as well. And I'll show you that in the full underwriting model, the dollars that we'd attributed to each of those. But again, in looking at just this was a pretty consistent condition of the existing property, very clean, very light lift if you wanted just to operate and just have incremental, increases on an annual basis. But we were looking really for the upside because of the situation of long-term ownership, they really hadn't been pushing rents very aggressively over their course of ownership. This little recreational area was what we had proposed. It was above the leasing office for the studio. On-site washer dryers, card operated, small leasing office, pool, and location. Phenomenal location. UC Davis, again, less than a mile away. You've got the Davis Community Pool. The main drag from the property from UC Davis is just north of the property here. So again, everything was proximate walking distance. It was a home run location. And I'll just show you this here because I'll reference this in the conversation as we get into it. Current rents, market rents. Some of the other income that we will assume in the high level cuts as well as we get into this real quick. And then we just jump into sales comparables. So now what I'm going to do is jump into the what I'll call level 1, level 2, and then show the level 3 on the underwriting. So I'm going to stop share.
Certainly good looking property.
Yeah, yeah. Had I done a little bit more homework, I would have upped the price and we should have been able to take it down. All right. So this model will look a little bit different from most, particularly on the scenarios tab and a few other changes that I've made. So as I'm going through it, it may look a little foreign, but you'll get the concept. And what I'll do to start, I'm going to start with what I call my high level cut. So this is really on the 2-minute analysis, right? So a couple of the key things you want, obviously number of units, gross potential income, economic physical vacancy, expense rates, and then your market cap. So very quickly, this is a 30-unit deal. We're going to add the additional, but I'll start with the 30. My gross potential, I'm taking from the new rents from the 2023-2024 school year, which was 51,370 times 12 to get my gross. Whoops. And then I'm going to add my other income, and I'm going to give them the benefit of the doubt, 17,000 on that. Super tight market. I know, people 5 and 5 for that 10% economic. This market is a sub-3 vacancy, very little bad debt because a lot of these graduate students, et cetera. I'm going 5% here total, and I know that that's outside of the norm, but that's this market. Every market's going to be a little different. You need to know your market.
Right.
This market as well, expense loads 35, 45%. I'll take the average of that, 40%. And again, market cap rate here, it was trading, it's still trading sub 5. I'm going to go 5.5. So I'm looking at this and I'm like, okay, 6.5 million. The OM says 8,250. I know that that's a rich offer. So I'm thinking to myself, all right, I just took the 2023, 2024 school year numbers. Now I'm going to, on this very same cut, I want to get a band. I'm going to take their pro forma, and their pro forma gross potential was 6,984,000. And I'm going to add my other income here real quick. Boom, now I'm at 7.5. So now I got a band. I got a 6.5 to a 7.5 range. Their ask was 8,250. So then you ask yourself, do I spend more time on this deal? And I'm thinking, okay, there might be something in that value add piece. I know I've got the opportunity on an annual basis for a majority of the residents to leave. I'm going to look and dive into this a little deeper. So that's my first cut. We're done there. And it took a little longer because I wanted to explain it, but that literally takes me 20, 30 seconds to do that. So now I'm going to jump into the scenarios for my deeper level 2 cut. And what I do with that, again, real quick, I'm going to enter my asking price here, 8,250. I'm just going to use my average on that banding from 6.5 to 7.5, which is 7 million, just to get me started. Then I'm going to just roll down the line here. We have a debt quote, 35%, 36 months interest only. Interest rate was at a 5.65. Again, this was last year, early in last year. I'm going to enter my unit counts real quick. As I told you, I was going to propose a 1 studio, 28 ones. We got 2 twos. I'm not going to enter a studio yet because that's going to be the value add piece. My current rents for the current year were 1686 on the ones. They were 2080 on the twos. My pro forma rents are 2,500 on the twos, and 1,900 on the ones. And my studio was 1,700. I'm going to go over here. Okay, let me see here real quick. Sorry. I'm going to make my gross potential equal to my OM current, because now on this little bit deeper dive, I want to see what the economics as a syndication, what they actually look like. Whoops. I want to take a gross times 12. This is my in place, just to give me, again, I'm trying to band it. I'm going to use my 3%, because again, I know that market is super tight. I'm using 1% of my bad debt because I think 5 is a little heavy, frankly, in that sub market. And I'm throwing in that 17K again. And then I'm going to change my expense ratio down here in my first cut to 40% again, because that sub market, that's how they operate, 35 to 45. And then what I like to do here is I do something a little different on the P&L. I have access to CoStar. I get these little vacancy and expense growth rates. I've modified my model a little bit here because I like data. I will plug in my vacancy rates. You can see here for the 5-year look, just again, something to benchmark. So I'm going to add these in real quick. 2.2, 2.3, 2.4, 2.5, and 2.7. Then I'm going to go up and do that same thing for my my market rent growth, 3%, 1.7, 3, 3.4, and 3.2. And again, these are benchmarks for me, right? Because again, down here in my ongoing vacancy and bad debt, I've got now a 5-year forward look. But again, this is just a high level cut look. So now I'm going to go back to scenarios. And I want to take a look here. Now, the deal doesn't look great. I need an exit cap. I'm just going to say right now, again, high level cut, 5.5. Everything's red. My economics do not look good in this scenario, right? Now I'm going to start modifying my splits real quick. 90-10. Whoop. Acquisition fee, sorry, 1. Economics still don't look great, right? So now I'm thinking, okay, that pro forma rent, I know these 2023 rents and my gross potential only are for the 1 school year. I'm now going to link my gross potential to my OM pro forma. Green. Okay, that's my level 2 cut. Now I'm saying to myself, okay, now I'm going to spend some time on this. I'm at $7 million on my offer, right? Ask is 8,250, and oh, by the way, they closed this deal at 7,350,000. So, now we can get into the deeper dive component, but you can see, and again, I do this level 1 and level 2 cut combined in about 3 minutes. That gives me an idea. Do I want to spend more time on this deal? This deal
Yeah.
was a yes.
And that's 3 minutes well spent right there.
Yeah, yeah. And again, this model is going to look foreign to a lot of folks because I've tried to make it. This is a control panel, one-stop shop. I control everything in the model from this one location, right? Once I change a few things, vacancy, rent growth, everything else is really dictated by this one page. So I don't have to bounce around. Everything's right there. I see how I'm manipulating everything. And so it just allows me to get through this really quickly. So once I do that, pull the other model up. Sorry, guys, bear with me.
Take your time. This is very helpful to see how you do all this. And
Sure.
it's great that you're such a data person because it pays off and now you can share your knowledge and
And
experience with us. So we appreciate it.
yeah, no problem. It definitely makes a difference, that's for sure. All right.
Hey, Jason,
Yeah.
when you mentioned about linking, after you did the second, you linked your pro forma.
Mm-hmm.
Is that from the broker or is that your pro forma?
No,
When
no,
you,
no. That's again, you're just trying to get an initial look. That's a broker pro forma.
okay,
Yeah.
that's what you and I have done after that is where we dive in and say, okay, let's talk to PMs and
Yep.
let's figure and make sure that we can dial it in to our liking.
Exactly. And again, all you're trying to do is this business is just it's a time business right now, right? Because there's such a dearth of opportunities. It's just getting through all of the literal garbage that's out there and trying to understand that, worst case scenario in place, best case scenario pro forma, you've got a band to work within there. Does it fall within something, based on how you're going to underwrite? Do you think you can make that happen? Because again, once you start applying the economics with the syndication and the splits, however you do that, do you do a preferred return? Can the deal support a preferred return? Right? Do you have an asset management fee that you can build in? Can it support it? Can you hit a 6+% cash on cash? Can you hit a 15 IRR? Can you hit a 2x multiple, right? So doing those high level cuts, the way that I just showed you on that level 2 cut, allows me to layer in what the syndication splits would look like to see if it warrants me even pushing forward on that. Or if it's a small enough deal, do I just zero out all the syndication splits as 100% and just do a JV with somebody, right?
Okay. Thanks.
Yeah. So this was the actual underwriting here. You can see, again, a few things that I like to do. I put OM current, and everyone's got a different philosophy and a different way they do it. This is what works for me. Everyone's, again, going to have a different way to do it. I like OM current. I like OM pro forma. I like a trailing 12 set of financials if I can. I've got my offer column here that I use to determine how I'm going to operate and offer. If I expand, I've got I can put my management budget in scenario A column here, but frankly, this is all I use is column 1 through 4. And again, the control panel over here for me is pretty much everything. A few things that I think are important for you guys to do as well. I got links that I like to link just for quick access, quick review reminders as well. I do a CoStar link if you've got access to CoStar. I do a property website link, Google Map, Crime Map, greatschools.org, city website information. So anything that's salient to how you're thinking about the deal, try to have a notes page if you can, or drop it somewhere on one of these tabs, because you're going to go 2 weeks, a month without reviewing the deal. You might get a call from a broker. You're not going to remember what the heck you did previously. So having this information at hand is crucial and important. But again, comparing numbers. Look, at the end of the day, ironically enough, actually, I had a property management team also provide a budget for us as we prepared for the final offer. And we ended up landing at 52.65% on our expenses. I told you I went in initially at 40%. We landed at 42.65. Something else that's important, another data set that I subscribe to called hellodata.ai, $250 a month. They do rent comps and some expense comps in the submarket, depending upon if they've got enough data to be able to do that. I like to have, again, data points to be able to just substantiate what I'm underwriting to. So this HP OpEx was from that hellodata.ai. They do a low, median, and high operating expenses for deals similar in that submarket. And ironically enough, the median was 267, and I was at 255. So again, just another reason as I'm doing my underwriting, validating the underwriting. Oh, I feel good about where I'm at, where I'm landing. Another key piece of it here, when I'm looking at a deal, I'm always looking at going in cap, I'm looking at current market cap, and I'm looking at a 5-year forward look to try to base my exit cap. The concept of adding 10 basis points to your going in cap, it's a legitimate way to look at an exit, and has been commonplace. My question is, if you get a deal that's at a 6.5 cap or a 7 cap, screaming deal, depending upon the location, was it a great value add opportunity? Having more data points to really give you some confidence on your exit caps are great. I subscribe to CoStar. I just use it for a 5-year forward look. I use it for current sales data. I use it for current cap rates in the marketplace, again, to help me determine what a potential real exit cap is going to be. Yeah, so that's just, I don't want to take up too much more time, but that just gives you a sense. I think another important thing that I've done here as well. Oh, by the way, so as I was underwriting this deal last year, I was underwriting on the high end to these value add, the 19 and 2500, which I showed you. They're already at an average of 29 or 21.29 for this school year. I was underwriting for 1932. So I left some meat on the bone, if you will, missed out on a great opportunity. by not sharpening the pencil a little bit further and thinking a little bit further ahead. What's year 2 look like? What's year 3 look like? So that was a little frustrating. So when you get into a best and final, and if it's a deal that you really want, do your homework, and don't make the same mistake that I did. So
Yeah, I know that was frustrating, but there is a lot to be said about learning from these and applying it to the future and sharing it with others. So I'm sure someday there'll be a situation where you'll almost be thankful for this because you'll know to do it a little differently, right?
yeah, they're just, with all this, there's just so much that goes into it, right?
Yeah.
And having as much data input to make a reasonable decision, particularly in today's market, is crucial. So, I try to subscribe. Obviously, everyone's got a different financial situation. I probably put out, 10 to 12 grand a year in various data sources myself. I look at it as value in the sense that I get one deal done, it pays for itself. If you've got the financial ability to do it, resource, look at various resources that can help supplement your underwriting, because data in today's environment is crucial. And it's also with AI now, the speed to be able to get to an answer, yes or no, is crucial as well.
Yeah, absolutely. So we have about 5 minutes left. Does anyone have a question they want to ask Jason? Although I think you're pretty thorough. You think you covered them all. Great, awesome. Keith, did you have a question? I know you had one earlier. He's good. He's good to go.
No, I'm good.
Great. Awesome. Well, Jason, thank you so much for joining us, for sharing your knowledge, for sharing this deal, for sharing the learning experiences from it, for going through everything. It's very clear that you put a lot of thought and intention and effort into what you do. And I know it certainly pays off, but it means a lot to have you share all of it with our community. So thank you again. For anyone that's watching this replay, if they have questions, they want to connect with you, where can they find you, Jason?
Yeah, you can reach out through the site. You can also email me direct. My email address is js@Montclair, and that's MONTCLAIR -CP.com.
Great. And we're also going to tag his LinkedIn and his site there. Thank you again so much, Jason. And I would love to have you back for another one. You've got so much knowledge to share. So we'll
Appreciate it.
see you
Appreciate the
soon.
opportunity, and good luck, everyone. Thanks.